here. All right, well, thank you very much for having me here today. My name is Mark Dannenberg. I'm the founder and CEO of Options Moneymaker. And what I'm going to talk about today is the art of trading. And this is all about how we earn more profits in less trading time. I had a long career with a Fortune 500 company. I don't want to spend my life sitting in front of my computer all day trading, so I have developed techniques that I now teach to others, which allow me to spend less time trading and still benefit from some pretty significant profits. My trading experience includes over 25 years. Futures, commodities, stocks, and options. I trade options exclusively now and have for the last 10 years. As I mentioned, I was a senior VP with a Fortune 500 company for 26 years. And while I was there, trading was a hobby of mine. I learned a lot about trading. I learned a lot about what to do, and I learned a lot about what not to do. And when I left my company, I enjoyed my career, really had a great career, enjoyed what I did. But when I left, I decided that I wanted to do something actively to help other traders move along the learning curve and experience success more quickly than I had. And so that's why I formed Options Moneymaker. I am mostly a trading coach, teacher nowadays, but I am also a trader. So if you're interested in learning, there are books to read, there are webinars to attend, there are seminars to attend, there are coaches to hire. There's all sorts of different ways to learn. Whether you decide to take a look at Options Moneymaker or not, one piece of advice I would give to you is find somebody that you can learn from who is also an active trader. Not all education people are active traders. Myself and my team are active in the markets every day. And so when we are talking with you about what's going on in the market or how to trade or adjust a position, we are talking from real-time experience. We've taught hundreds of traders since 2006, and we continue to attract new traders to our community at Options Moneymaker. We do spend a fair amount of time on strategy design. We want to take basic core strategies, and then we create variations of them or rules around them that make them relatively simple, allow us to be consistent with our trading, allow us to be profitable, and we want to have fun while we trade. Trading for me started out, as I said, over 25 years ago, and I started doing it because I was quite interested in it. It looked kind of exciting, you know, it was better than some of the other things that I could be doing. So I still want to enjoy my trading today, and that is a key component of what we try to design into our strategies. The target audience for what I'm going to be talking about today is really any level of option traders. This strategy in particular profile today is accessible by any level of trader. Now you may require some training, you may require some coaching on it, but still it's not something that is overly complex that you have to be an advanced options trader in order to be able to take advantage of it. It is important that you have some basic knowledge of the characteristics of options. Things like the delta value of an option, what time value is versus intrinsic value, strikes and expirations. Those are the basic characteristics of options. If you don't understand the basic characteristics today, it'll take you about an hour to understand them. Seriously. You can learn the basic characteristics of options. There's lots of free information on that through most trading platforms. It is important that you become familiar with diagonal spreads. These are debit spreads. These are option positions where you are putting together two different option legs to form a diagonal spread. But again, that's a relatively easy concept to understand. I'm going to walk you through an example of that as part of a strategy that I want to profile for you today. You also should be interested in earning consistent profits. Most people are interested in that, but they're not able to actually achieve that. Sorry, hold on a second. They're not able to achieve that. A lot of traders will single trade. Some of that is because they become overconfident with what they're doing. Some of it is just because they are more focused on the profits and the opportunity rather than the potential pitfalls and potential risk of a trade. We try to focus on both of those to help our traders. And certainly, if you've come to the webinar today to listen, then hopefully you're willing to break maybe some unsuccessful patterns you have and you're looking for an opportunity to be more successful. Now, before I get into actual strategy, the strategy that I want to profile today, I want to just pause here on this one slide and talk about I have after trading for 25 plus years on what causes anxiety for traders. Anxiety is not a fun thing to have when you're trading, and I've kind of narrowed it down to a few basic things that cause that level of anxiety. And I believe every trader ought to pay attention to this in order to relieve themselves from a level of anxiety that interferes with them actually making good, sound judgments in their trading. The number one cause of anxiety, in my opinion, is you have too large of a capital commitment. You've got too much risk on. You've got too many contracts. You've got too many positions. When you go to sleep at night, you're worried about what the overnight futures are going to tell you. You're worried about how the market's going to open tomorrow. You can't sleep soundly because you're afraid you're about to lose a whole bunch of money. If you are in that state, in that frame of mind, you have too much of your capital at risk. Now, too much or too little or not enough or and such is all going to be different from person to person. Too much, if it's $5,000, that might be too much for somebody who has a $30,000 account. That might not even be the blip on a radar for somebody who's trading a $100,000 account or a $500,000 account. Or if you're trading a $500,000 account and you have $5,000 at risk, just because of your personality, you might find that to be uncomfortable. So part of this is you feeling comfortable. What is it, what size of a position would you have to put on to feel confident even if that position really started to work against you? Second reason is you have a lack of understanding how to properly manage or adjust a trade. If you know how to put on a trade and the minute you put that on, you're nervous, you don't have any understanding of how to properly manage or adjust the trade to get yourself out of trouble, to minimize any drawdown or loss on the trade, or perhaps turn a losing trade into a winning trade. That's where you really need to devote some time to learning and understanding how to do what you're doing rather than just flying blind. Impatience and very short-term focus, this is where you really feel like you want to tell the market what to do instead of being okay with whatever the market is doing. You really want what the market wants. You don't want to want what you want. You also don't want to be impatient. You don't want to force the market to move in your time frame. Financial media can also be a source of anxiety because you think you've got a good sound trade, you think you have a good understanding perhaps of a technical perspective of a chart, you hear some news story and it all of a sudden puts your thinking out of whack. Financial media is best left off to the side after the market. Don't let it interfere with your trading. And I already mentioned wanting what the market wants. Wanting what you want rather than what the market wants. And then speculation rather than management. There are ways to manage trades. There are ways to secure the profit that you have in a trade or diminish the risk in a trade rather than just kind of throwing a Hail Mary out there. Those are the general causes of trading anxiety that I've found over the years of training and teaching hundreds of traders, and I'd really like people to avoid that level of anxiety and enjoy their trading. So at Options Moneymaker, our team's philosophy for winning is generally to trade strategies that win regardless of direction. Now, sometimes a position can start out as a directional trade, but we have strategies that are going to be able to um, reduce the directional nature of that trade and win regardless of which direction the market moves. We leverage the basic characteristics of options. We leverage the delta and the time value of an option to our favor. That is key to us being successful. We also want to use a simple, repetitive approach to our trading. Simple, repetitive. We want to have it so simple and repetitive that we are programmed over and over and over again to know what to do and when to do it. And that way, we are not emotional beings that are influenced by other factors. When you repeat the same thing over and over again, it increases your level of understanding. And when you have a higher level of understanding, you're going to have a higher degree of confidence and higher degree of success. We want to trade small position sizes and compound frequently. I'd rather trade a very, very small position, take a small profit, take that exact same capital, roll it into another new trade, take a small position again, make another small profit, continue to roll it into new trades, compounding the capital frequently, and therefore actually growing the overall size of an account even though we started with a small amount of money. We want to set aside fear of the market. We don't want to be controlled by fear. We want to have fun. We want to enjoy our trading. Options Moneymaker, I have a great team of traders and coaches and teachers, and we tend to enjoy what we do every day. Now, the Market Tamer is a strategy that I want to talk with you about today. The Market Tamer is just one idea for successful trading. The Market Tamer is a strategy that we have worked with over the last several years. It's a proprietary strategy that we've really worked on sets of rules for trading the Market Tamer. I don't want to say that this is really the only. I'm not proposing that this is the only single source for trading, but if you want to start options trading, it's a good idea to start with a single strategy and do that strategy over and over and over again. You're going to take a lot of profits. You're going to have some positions that you're going to take losses on, and the net cumulative effect should be something that's very positive to you. So I'm going to walk you through an example of a Market Tamer to show you how simple the Market Tamer can be. It's a simple strategy that is available for all levels of traders, even fairly new traders. It has a relatively short hold time when constructed the way we do. You can trade as many as 1 to 3 positions per week. Now, 3 positions per week is quite a lot. 1 position per week is pretty much normal, but over a 2-week period, you might be trading let's just say 2 to 3, 2 to 4 positions over a 2-week period. So there's a recycle time frame in there that allows you to take your profits and recycle then into a new trade. Commit just 15 minutes per day to review your position. Okay. Now, you probably hear a lot of people talk about you don't need a lot of time to trade, and then once you start digging into it, you realize this takes way more time than I had thought it was going to. I'll tell you that I know it's 15 minutes per day because myself and my team have a phone call every single day, and we review our positions. So if you're trading a single position, for example, a Market Tamer position, I know that that can be reviewed easily in 15 minutes per day. We actually invite our clients, our subscribers, to listen in on our call every day so that they hear in real time exactly what it is that we're thinking about regarding the market, what it is that we're thinking about regarding our position. We make adjustments when necessary, and we have that discussion on a daily basis. We do that mid-market day. I'm on the west coast of the United States, so we're doing it about 9:30 in the morning, and after that, then we're off doing other things and waiting for the next day. The Market Tamer is also a great strategy if you're not real good with your technical charting skills. If you're maybe just getting acquainted with technical charting, the Market Tamer is a great strategy which allows you to take advantage of a good trading strategy without needing to be real precise in your charting. Trading the indexes, and when I say the indexes, I don't mean the ETFs. I mean the NDX, which is the NASDAQ 100, the SPX, which is the S&P 500, and the Russell 2000, RUT. Those are the three primary indexes that we will trade using the Market Tamer. There's no fundamental analysis required, and if we don't need a lot of charting skills, it makes for an ideal combination, the Market Tamer, using those indexes. The Market Tamer also is a strategy that when it requires some form of adjustment or modification to the trade in order to nurture it along closer to being profitable, there's no significant management required. There are no huge drawdowns on a Market Tamer position. So it's designed to leverage the cycles of an equity. Okay, what we do know is, and I'm a hardcore technical charting person, and I know that whenever I look at a stock, whenever I look at a index, that those stocks and indexes, they cycle. It can be trending up, it can be trending down. It might have been trending up for the last year, but within that year, there are multiple cycles that are moving up and down in that overall trend. We are going to take advantage of those cycles. We're also going to take advantage of the decaying time value of options. When you're the seller of an option, decaying time value is a significant part of your potential profit, and that's what we want to take advantage of. When we open a Market Tamer, we have the possibility of earning profits regardless of which direction the market is moving. So as I said before, this is really good for traders who do not have strong charting skills. And once we put on a Market Tamer, we actually don't care which direction the market moves. We don't care which direction our index moves after we've opened our position. This is designed to be a short-term, high-profit trade. Okay, not every position is profitable, but you're not going to have huge drawdowns on a Market Tamer. And then we require minimal adjustments to this trade. So the Market Tamer is ideal for eliminating fear. We don't have to panic and lose our mind and bail out of a position, no panicked exits, and no sleepless nights. So let me explain to you what a Market Tamer is so you can have some idea of why we think that this strategy, why we've shown this strategy to be such an outstanding performing one for the last few years. Market Tamer position consists of four, like it might be an advanced option strategy, but as you watch this unfold in my example of this strategy, you're going to see why it's actually a relatively simple strategy. Those four legs are made up of a call debit spread and a put debit spread. Now these are debit spreads because you are paying money to open the position, as opposed to a credit spread where you may actually receive a credit into your account when you open that position. These debit spreads can be made up of either a diagonal or calendar spread. So the strikes can be the same or the strikes can be different, but they have different expirations. In order to open a new Market Tamer position, the one caveat here is that we want the index to be trading at or near a strike. We want it to be trading at or near the strike of our index. So, for example, if the index was trading at SPX, for example, and SPX was trading at 1835, well, there's an 1835 strike because the strikes are presented in 5-point increments. If it was trading at 1832.50, well, that's halfway between 1830 and 1835. I probably would not choose that moment to open a position. I'm going to wait for it to actually move a little bit closer, either 1835 or 1830. You can use either monthly or weekly expirations in order to open a market tamer, and that's what gives us a lot of flexibility. Actually, I got a little bit ahead of myself here. This is a good example of what I mean when I say that we have to assess the current price of the index to see if it's trading at or near a strike. So, for example, 1820.9 is near the 1820 strike. 1839.29 is near 1840. This is somewhat subjective. Maybe within $1 is close enough. You're rarely ever going to get it right spot on, but you don't want to be too far off of the strike. As I mentioned, chart position is not important for the market tamer. So we're going to build an example position here in the next few minutes. And we're going to assume for building our example position that SPX is trading at 17.99. Okay, we're going to make an assumption that it's trading at 17.99, and we're going to build an SPX market tamer position. What we're going to do is we're going to start by buying to open a call and a open a call option, and we're going to buy to open a put option. The expiration for this call and put option is going to be 3 to 6 weeks out from today, 3 to 6 weeks out on our options chain. And we're going to buy to open at the money, ATM, at the money. That means that if the index is trading at 1835, we're going to buy to open the 1835 call, and we're going to buy to open the 1835 put. Okay, so we're going to buy to open at the money, and we're going to buy to open 3 to 6 weeks out on the chain. Simultaneously, we're going to sell to open a call and sell to open a put. Now the call and the put that we sell we want the call and put that we sell to be closer on the chain than the call and put that we buy. Now this shows that if I follow exactly the rules as I lay them out here, I actually could sell 3 weeks out and I could buy 3 weeks out. Okay, so I want to point out to you that one very important rule of constructing a market tamer is that there should be a minimum of 1 to 2 weeks between the longs, the calls and puts we're buying, and the shorts, the calls and puts that we're selling. So you should have 1 to 2 weeks out. So if I went 1 week out for my shorts, the ones that I'm selling, I could go 3 weeks out on the longs. If I went 3 weeks out on the shorts, then I'd have to be a minimum of 4 weeks out, but preferably 5 or 6 weeks out on the longs. So pay attention to these: 3 to 6 out, 1 to 3 weeks out, but don't forget about leaving 1 week to 2 weeks in between the expirations of the longs and the shorts. We're going to sell to open 10 points out of the money. So we bought to open at the money. Now we're going to sell to open 10 points out of the money. So here's our position. Assuming that SPX is trading at 17.99, and we're going to buy to open March week 1. Okay, this is an old example, right? This is an example from a real trade that we were trading. We're going to buy to open March week 1 call, and we're going to buy to open the March week 1 put. We're going to buy to open 1800 because that's the closest strike to trading at the money, and it's within $1 of our strike. The SPX is trading within $1 of our strike. We're going to sell to open the February. Now this was 1 week out at the time, the February monthly expiration. We're going to sell to open the 1810 call, and we're going to sell to open the February monthly 1790 put. All right, so 10 points call. Now, technically, the call is 11 points out of the money, and the put's 9 points out of the money, but those are the closest strikes that are available to us, so those are the strikes that we traded. Here are the debits and credits that we are trading each of these legs for. The debits on the longs, the credits on the shorts. You net together those debits and credits, and we have a total investment risk of $26.95 to put on these 4 legs. That's $26.95 per share. So if you did 1 contract, with 1 option contract being equal to 100 shares, this would be a $2,695 investment. Now, this position has the likelihood of being profitable if SPX moves up, if SPX moves down, or if SPX remains flat near the current price. Time decay on the short legs, time decay on the 2 legs that are 10 points out of the money is the primary driver of being able to close the entire position for a profit. The movement of the stock combined with time decay offers opportunities for profits, opportunities to close all 4 legs for an overall profit. And we don't really care now which direction the SPX moves, because our market tamer will benefit regardless of which direction it potentially moves. So let's evaluate what can happen to this position on a movement or no movement. Our position is the 1800-1810 call spread and the 1800-1790 put spread. Okay, we have both of these. They're back to back with the call and put long remains in a range between 1790 and 1810. So Market Tamer is hugely profitable in situations where an index or a stock is range bound for a period of time. Remember, when we open this position, the short legs are only 1 week from expiration. We're only going to be in the trade 5 or 6 days at most, and we're going to see a fairly rapid decaying of the time value in those short legs. So we have what's called a sweet spot. And the sweet spot is that space between the 1790 put and the 1810 call. That's a 20-point range. That's a 20-point range, and as long as we stay inside that sweet spot, then we could potentially achieve the maximum amount of profit that a market tamer position can provide. If we carry this position all the way to expiration of the short legs, then here's what could potentially happen. If we are inside the sweet spot at expiration, then the 1790 put is out of the money, and at expiration it would have no value. And since we sold it originally for a credit of $12.05, we get to keep all of that as profit. The 1810 call would also be out of the money, so it would have no value at expiration. And we sold it originally for $8.30, so we would get to keep all of that credit of $8.30. That gives us a total of $20.35 of profit from those two short legs. But now what's going on with our long call and our long put? Well, what you'll find with the Market Tamer is that for the most part, the long call and the long put will offset each other. There can be movement one way or the other. We might have moved down a few points, or we might have moved up a few points and still been in the sweet spot. And either the call or the put may actually be showing a profit with the other one showing a loss. For the most part, that loss and that profit will offset each other for no overall profit or loss on the longs. The reason for that is because when we opened the long call and the long put, the delta values on those were very similar, if not identical. And so because the delta estimates the rate of change in the value of an option for each dollar change in the value of the underlying equity, if I have equal deltas or comparable deltas, then for the most part, these are going to offset each other. So we get all the way to expiration, a week after we open the position. SPX is inside our sweet spot, and we have a $20.35 profit. We've closed the long call and long put, no profit, no loss. The short call and short put have expired, worthless. We're completely exited out of the position, and we have a $20.35 profit on total risk of $26.95. That seems like a pretty decent profit to me for 1 week. But is that real? And my answer to you is yes and no. In my years of trading options, I learned not to be greedy, and you don't want to be greedy on a position like this. An index or a stock could be range bound, and at any moment it can pop out of that range and it can start moving more dramatically. If I had a 10 to 20% profit within a couple of days or within 3 days on this position, I'm going to close it out and take that profit. Yes, I'm giving up a potential bigger return, but I also recognize through my experience with the market tamers that if there's all of a sudden a bigger move, I may need to manage or adjust the position. I can still turn the position after a big move into an overall profit, but now it's going to require more work. It's going to require more attention from me, and I like the easy, simple path of opening and then closing for a nice 10 to 20% profit. And in our experience, we've found that this 10 to 20% profit range is kind of the sweet spot in terms of being able to take a profit. Sometimes we close for less, sometimes we're able to close for more, but that seems to be the sweet spot in terms of our profit range. The longer you hold the position, the greater the chance that you will actually need to manage or adjust the position. We try to avoid management, but we're not afraid of it. We teach a lot of management and adjustment techniques to try to nurture your positions along to a profit, but we don't go into a position or make decisions on a position just because we know we have management available to us. We'd rather not manage if we don't have to. The other reason to grab your profits when you can, especially if you're in the 10 to 20% range, is that the long legs, the 1800s, they also have time value, but that time value is working against you. That time value is working against you because you paid for those long legs. As you're getting closer to expiration, the time value is diminishing. Now, granted, those long legs are an extra 2 to 4 weeks further out than the shorts, so the rate of time value decay is not as rapid as it is on the shorts, but still they will be losing some time value. And that's what we refer to as slippage on the longs. So you can have a situation where the two longs are not completely offsetting each other. Let's go back and look at our position here. Perhaps they don't completely offset each other. Perhaps there is an unfavorable offset, which means there is slippage on the longs. And we still have $20.35 of profit from the shorts. Well, let's just say, what if we had $5 of slippage on the longs? Well, we still would have a very nice profit overall because the time value decay on the shorts is giving us that level of profit. So you don't want to be greedy. You don't want to hold for every last ounce of profit. You can very quickly see what was a profit turn into a potential loss and something that then you have to work harder at to manage. And that's not the way we like to have fun in trading. Now, the position that we have, again, as a reminder, is the 1800, 1810 and the 1800, 1790. If the price of XPX moves up, for example, and I'm kind of arbitrarily picking 1825. I show this as a 25-point move up. Technically, it's a 26-point move up because we are trading at 1799 when we opened it. But let's just say there was a 25-point move higher, which means we're no longer inside our sweet spot. Remember, our sweet spot was defined as the 1790 to 1810 range. What happens if at expiration SPX is trading at 1825? Well, the 1790 put is going to be out of the money, so it'll have no value, meaning it will expire worthless for a profit of $12.05. That's still our profit, okay? The 1810 call is now going to be in the money, and we're going to lose money on that. The 1810 call, if the index is at 1825, is 15 points in the money. So 15 points in the money means at expiration, I need to buy back this call for $15. I need to buy to close for $15. But I took a credit originally of $8.30. So I get to keep that credit. I have to pay $15 to buy back the option. That gives me a $6.70 loss. If I assume that the 1800 call and put offset each other for no profit or loss, again, that means that I net my 670 loss against my 1205 of profit on a 2695 investment. That still is just under 20% return for a week. Now, again, if this was what was developing, at some point, there's going to be an opportunity to close out of all four legs, probably for less than 535 of profit, but I can close out of all four legs and not carry this all the way through to expiration. If the SPX has moved up to 1825, it's possible it did that, in progressions of movements as we move closer to expiration. I don't need to wait for it to get all the way to expiration, and I don't need to wait for it to get all the way to 1825, which would be well outside of my sweet spot. I would have an opportunity to. On 2695, I only need $2.70 for a 10% return. Even if I saw the index starting to move more dramatically, and if I had $1.30 of profit, $1.35 of profit for 5%, you have an opportunity, because of the dynamics of these four legs working together, to exit out even for a smaller profit. And you know what? I'd be pretty happy with 5% over the course of a few days, have all my capital back, and move on to the next trade. Now, time decay of the stock is moving against your short call. So what's happened here is our short call has become unfavorable to us, but time value decay on that short call plus time value decay on the short put are all working in our favor. So we do have some room for it to move unfavorably against one of our shorts and still be able to exit out of all four legs for an overall profit. The long call, long put offset each other. We might have some slippage, even in a situation where, sorry, let me go back here. Even in a situation where we had slippage, gosh, even if we had $4 of slippage on this, you'd still have a 5% return. So we have built into the strategy an allowance for slippage, and you can have some slippage on a position and still exit out for an overall profit. There will be some of these trades, just because of the dynamics of the market, that will be closed out for a loss. Generally, that loss can be a very small loss, and generally that loss can be recovered in the next trade. But I'll talk in a minute about doing some modifications or adjustments of these positions. Profitability of a market tamer position is driven mostly by the decaying time value of those shorts. You can see here that 1205 plus 830 in credit, you've got $20.35 of credit, the minimum of $2.70 of that to decay away to get a 10% return. So the dynamics of the position work very well. The direction of the movement does not matter. So this eliminates the worry of positions moving against you. How many of you wake up in the middle of the night, maybe check the overnight futures, and can't go back to sleep because you see that the markets are setting up to move against a position you have? That doesn't happen with a market tamer. We don't really care which direction it moves. So managing risk is as important as it is to open a good position and use good strategies. So successful trading is as much about managing and adjusting the position or adjusting that risk as taking profits. The selection of the strikes and the expirations for a market tamer will optimize or diminish the opportunity. So there are different variations to a market tamer in the construction. What I shared with you as one example today is opening at the money and selling 10 points out of the money. You can actually construct a market tamer where you sell and buy at the money, or you can construct a market tamer where you buy at the money and you sell as far out of the money as 50 points on other indexes. So there are variations to constructing this market tamer, but each of those variations will offer you a profit opportunity. Market tamer is an excellent strategy. However, sometimes the position needs to be adjusted. Sometimes the market doesn't cooperate with us. Sometimes our position just needs a little bit of attention. That's okay, because that's just a natural part of trading successfully and profitably. Once the price moves through the strike of one of the shorts, you may need to adjust the position. That's basically saying that once it's outside the sweet spot, you're better off to adjust the position than just sit and hope that it's going to be okay. Management techniques are as important as generating consistent profits. So here's an example, okay? If you had this market tamer in place and you saw it move, you saw the index move up to, say, 1825, 1815, but anything outside the sweet spot, which was 1810, that's the boundary of our sweet spot on the call side, you're better off to actually close the position and reopen all four legs at the money using the same expirations. So let me just say that again. You're better off to close the position and reopen at the money. What that means is you'd be closing your 1800 Market Tamer with 10-point out of the money shorts, and you'd be reopening an 1825 Market Tamer with 10-point out of the money shorts. What is fairly consistently known with the indexes is after a big move, there's generally a pause, a pausing period, taking a breath, and that is a perfect opportunity to let a market tamer idle while the index is kind of idling in a tighter range. So if you take your 1800 position and you adjust it to being an 1825 position, where now you're short the 1835 call and short the 1815 put, then you've given the position an opportunity to take advantage of a high likelihood that the SPX will get closer and closer to expiration. And so that means that the time value on those shorts is going to be decaying far more rapidly. The closer you get to expiration, the more rapid that time value decay will be. When you adjust a position in this way, when you close the current position and reopen it using the same expirations, but you center it at the money, you will get more time value in your shorts than if you sit and wait for the current position to show you a profit. Now, the reality is about 50% of the time, okay, that's just a broad brush, rough number, about 50% of the time when you are closing and adjusting the position, the other 50% of the time you may have a small loss, but it's not going to be a huge loss. It's not going to be this dramatic drawdown that's going to significantly affect you. It's going to be a small loss or a small profit generally when you do this kind of an adjustment. And what you're really doing is saying, I'm going to follow the cycles of the index. The cycle has been up dramatically. I'm going to follow it. I'm going to center my position at the market so that I can take advantage now of the rapid time value decay. If I had to close the current position for a small loss in order to then reopen it at the money, and I used the same expirations, then I have a very high likelihood of not only recovering that small loss that I took in that expiration, but then ending up with an overall profit. This is a very simple adjustment. This is the type of thing where you review your position once, maybe twice a day. Devote 15 minutes or so just to kind of review what's going on with the position and make a decision whether or not you want to make an adjustment. If you don't make the adjustment today, make the adjustment tomorrow. This is not a situation where the market has moved maybe 10, 15 points outside your sweet spot and you have to do the adjustment immediately. This is not a fire drill type strategy. You can wait until the next day. It's possible that the market will cycle back down the next day inside your sweet spot and no adjustment is necessary. But if the next day it is still outside your sweet spot, go ahead and make that adjustment. You're going to be glad you did because this is all a matter of nurturing each position along, massaging each position along closer and closer to expiration to take a profit. The other thing on market tamers is you need to pay attention to the volatility when opening a new position. This mostly applies to stocks, although the indexes like SPX and NDX, it's easy to see the volatility because VIX, the VIX, VIX, or VXN on NDX, those are the volatility indexes on those two indexes. And so it's really easy to see what the volatility is. The reason we pay attention to the volatility is because you want to open market tamers generally when volatility is in the lower range of a historical volatility range. So when implied volatility is in the low end of the historical volatility, then that's a good time to be opening a market tamer. If you ignore that and you decide to open a market tamer when the volatility is high on a stock, for example. There are a lot of stocks out there that we've been trading other strategies on that we love the volatility on, but I wouldn't think about opening a market tamer on them. When you open a market tamer on a high volatility stock, you're buying premium. Now remember, we are leveraging time value decay on the shorts, but essentially we are buying premium. And that means that you're actually buying premium with high volatility, so you're really paying more. You're paying a premium for those spreads. If then after opening the position, volatility were to drop dramatically, you're going to experience a more significant amount of slippage on those longs. You're going to experience more slippage because the drop in volatility is going to take the overall value of the options lower, and both the long call and the long put may actually then become unfavorable and could actually be unfavorable enough to offset any type of reasonable profit on the position. So that's why we talk about volatility, and generally we try to avoid taking positions on high volatility stocks. We stick to the indexes primarily. The indexes are fairly predictable in our opinion. They're fairly easy for us to understand what the cycles are. They're easy for us to feel confident that you're not going to have a dramatic movement that's triggered by a single stock or an announcement on a single company. So we love the diversification that the indexes provide. If you are going to start trading the market tamer as a strategy, either as one of your strategies or perhaps a single focused strategy, I would recommend that you trade on the SPX and NDX. Now let me just address a question that maybe somebody will ask here when I get to questions, but it tends to come up frequently, is why SPX, not SPY? Are the core indexes and the premiums that are available for those for us work extremely well. The ETF of SPY or the Qs or IWM on the Russell 2000 index, they will work just as well, but you get, you're working with much smaller numbers, you're getting much smaller credit, you're getting much smaller time value. The overall dynamics of the position is different. You need to decide how far out of the money you're going to go on those shorts because they're presented in $1 increments. So what I'm trying to say here is there's nothing wrong with trading those, and if that's something you want to do to kind of get your feet wet with a market tamer, I invite you to do that. I will just tell you, we have rarely traded the ETFs. We trade profits in the 10 to 20% range. Holding longer is going to increase the need to adjust or manage a position. Okay? So the art of trading, part of what we refer to as the art of trading, is starting with a small amount of capital and trading even just 1 to 2 contracts per position. 1 to 2 contracts per position is not going to make you wealthy overnight. It's not going to earn you a huge amount of profit in a single position, but 1 to 2 contracts per position could consistently give you profits on every single trade, and then you cycle the same capital into the next trade. And if you're able to do even just one position per week over the course of 52 weeks, And if you started with even just $5,000 and you were able to earn 4% per week. Now remember, with our Market Tamer, our target is 10 to 20% per position, knowing that we will take less than that if we feel that it's appropriate. But if you just did a straight mathematical calculation here, started with $5,000 and you earn 4% per week for 52 weeks, but you're compounding the return, meaning you're going to earn 4% on 5,000, and then the next week you're going to earn 4% on 5,000 plus the profits of the previous week, and you continue to compound the return. Eventually, you're going to be increasing from maybe 1 to 2 contracts to 2 to 3 contracts to maybe 4 contracts. You're going to increase it as you grow the size of your account. But just at that very simple compounded rate, a $5,000 account over 1 year can grow to a $38,000 value. Now, what if we were wrong? What if this simple compounding doesn't work quite that cleanly? What if it's not always 4%? You might have some drawdown some weeks. What if you knew confidently that just by trading simply and devoting 15 minutes per day, you could grow from 5,000 to 20,000 or 15,000 and basically triple the size of your account? I personally think that that is a great way to trade because it gets you into the game. It doesn't take a tremendous amount of your time. There is very little anxiety associated with trading a small number of contracts or smaller amount of capital. And so now let me pose the question to you, what happens if that was 6% per week instead of 4% per week? Well, the compounding effect grows 5,000 to 103,000. Just that small little 2 percentage point difference in terms of the compounding. Now, what if you didn't actually grow to 103,000, but you grew to 50,000? Significantly less than 100, but 50 or 40. Whatever it is, growing a $5,000 account, committing 15 minutes per day, small amount of capital, small number of contracts, easy trading, single focused strategy. It's a very powerful way to start small and grow big. So that's one of the things that we promote. That's one of the things we encourage people to do. And I'm not necessarily saying that the Market Tamer has to be that strategy, okay? It doesn't have to be your single focused strategy. It's one suggestion for you, but you can do this very easily with credit spreads or with any other strategy that you like. One of the errors that I think a lot of traders make is accumulating too many different strategies in their. It complicates things, and that is not a comfortable way to trade. So my summary here is that we're big fans of trading a single focused strategy until you're a very experienced trader, and then you maybe trade 2 to 3 different strategies at the same time. But we're not loading up on a lot here. Start small, grow big, small increments. So the Market Tamer strategy combined with the knowledge of proper construction, how to construct it, which I've just given you a great example of, as well as how to do adjustments, which that would be adjusting when it moves outside of the sweet spot, can earn more consistent profits. It can help you eliminate worrying about market direction. It will allow you to respond to what's going on versus reacting out of fear. It will allow you to leverage the cycles as the stock moves up and then back down. As long as it's inside the sweet spot, you are really in a good place to continue to hold that position. All of that combined allows us to have more fun with our trading. So if you're interested in learning more about what we do. I'm just going to give you a couple minutes of summary about what we do if you have an interest, and then I'm going to go to take some questions. We do provide instruction that goes much deeper than just the Market Tamer. It's called our Trade to Win program. It covers charting with multiple technical indicators. Not all of our strategies are non-directional like the Market Tamer, so we do trade directional strategies also, and we're big fans of our technical charting. So we go into depth on that. We teach strategies, both directional and non-directional, credit spreads, debit spreads, the Market Tamer, and then one of our other more advanced strategies called the. And we teach management techniques to recover any position. Now we focus on management as a way to protect our portfolio. We can't turn every single trade into a winner, but we can usually do a pretty good job of diminishing any significant drawdown on the portfolio from a position. That's our Trade to Win program. If anyone is interested in learning more about it, the price for the Trade to Win is $39.95. You get about 25 hours of video with that. You get access to a live weekly webinar where I teach for an hour every week on additional aspects of our Trade to Win program, going deeper in charting, going deeper in our strategies, and going deeper in our management techniques. You also get access to our daily call where myself and my trading team are talking about the market and reviewing positions every day, and you get to listen in on our thought process. But one of the programs that a lot of people have shown interest in, our community at Options Moneymaker is growing very rapidly, particularly due to our 5K challenge. So when I talked earlier about starting small and growing big, we have a program specifically designed for that. You as a trader start with a $5,000 trading account. We will provide to you email alerts every day with specific steps for each trade, whether we're getting into a trade or getting out of a trade or adjusting a trade. We tell you exactly what you need to do. We provide one trade at a time. When we are in that trade, you get to listen in to us every day for 15 minutes, talk about that trade and why we should keep it or why we should manage it. We don't know how big everyone's account is going to grow. Everyone's starting at a different time. So we're going to measure your success for this one-year program until March of 2015. If somebody else joins us in July, they have a one-year program from July through June of next year. We don't know how big these 5K accounts are going to grow. You know, it could possibly grow as much as $100,000, but I'd be happy if we grew to 30. I'd be more happy if we grew to 50, and I'd be ecstatic if we grew to 100. That, for us, is the fun of trading. We're having a lot of fun with the 5K challenge. We're going to continue to have fun with it. If it's something you're interested in participating in, you can either choose from a monthly fee of $159 per month, or you can do a one-year paid in advance prepaid for a much lower overall price of just $995 for 12 months. If you're interested in signing up, the web address is www.optionsmoneymaker.com/TP/. Feel free to also email me if you have questions, Mark@Options Moneymaker. All right, so let me just minimize my screen here so I can see the questions that are coming up. All right, let me see here. All right. Can you do options on Forex? I will have to defer that question to someone that's more knowledgeable about that as me. I'm sure there's a way to do them. I don't trade Forex at all, so I can't answer that question for you. What dictates how far out, 3 to 6 weeks, you go? You start trading the Market Tamer. As an example, today is Thursday. I'm going to go out for my shorts. If I was opening a new Market Tamer today, I'm going to go out for my shorts 1 week. Okay, I'm going to go out to next week and sell. I'm comfortable going 2 weeks further out than that on my longs because I only really have 1 week to the shorts. If instead I wanted to go out 2 weeks for my shorts, not sell next week, which is the monthly, but go out 2 weeks, I'm probably going to want to go out a little bit longer, farther out on the chain for my longs. And the reason is because now I've got 2 weeks of potential hold time for the shorts, and that is 2 weeks of potential time value decay on my longs. If I push my longs out an extra week or out even an extra 2 weeks, then the amount of time value decay will be lower on those longs. So that's kind of the variable. It depends on how much time I have on my shorts, and that's going to help me decide how um, how far out I want to go on my longs. Is this an iron condor or not? Well, an iron condor, in my definition of an iron condor, is really putting two credit spreads together. These are two debit spreads. Has a lot of similarities to it, but the dynamics of the two diagonal debit spreads work very much differently than two credit spreads together. How will volatility affect the trade? I think you probably asked that question before I talked about volatility, but just to make sure you didn't miss that, volatility will affect the trade if you open a new Market Tamer position with variable that will affect the trade. What is your performance record on this strategy? That's a great question, and we are just days away from actually updating our website. We're going to have a section on the website where we're going to be posting the performance record, track record of our Market Tamer strategies along with all of our overall strategies. So please visit our website probably early to mid next week. We should have everything posted up there, optionsmoneymaker.com. SPX 30-point range today. Yes, sir. A lot of fun. Wouldn't be surprised. There's some technical indicators showing that it could possibly bounce back up tomorrow. Not sure how far, but it's a good example of a day where I probably would not move my Market Tamer. In fact, we actually took profits on a Market Tamer today, and then we just took a pause and are waiting to see where the market settles before we open a new Market Tamer. So this looks like an iron condor, but it's a net debit. I think I responded to that already. I think it works better on Russell than SPX. I don't agree with that. If you have traded the Market Tamer, you'll know that that's not true. If you have not traded, then I would just tell you to look at both the SPX and the Russell. They're both excellent indexes for us to be able to trade. How about trading butterflies on SPX? Entirely different strategy, not something I'm going to address here. How about using SPY? I think I already addressed that. SPY will work for you, but it's not something that we trade. We try to keep our trading fairly simple and stick with one core set of indexes. There is a question, can we get a copy of this? And Jana put out here that we're recording all the sessions and we'll send copies to all registrants. So that's good. Appreciate that. And let's see here. In that last slide back up, talking about this slide right here. If you're interested in signing up for our 5K challenge, it's www.optionsmoneymaker.com/TP/. I'm just trying to finish up the questions here. SPX Market Tamer spreads are very wide and difficult to get in and out at reasonable price. Do you enter at market price? Absolutely not. We don't enter at market price. We work the spread, and they're not difficult to get in and out of at all, the way we trade these. I think my time is up. Morgan, Yana?